The myth, the man, the legend is here. Phil Hodge, he's CEO of Pinecliff Energy. As we said, they were the top ranked company in our screen, and he's been running the company since 2012, right, Phil?
That's right.
So long history of stellar performance. And so it's a great, we're very lucky to have him here to talk about the company because he's a very long history of running this stock. It's not, he didn't come from somewhere else and is trying to make changes. And so all the performance you've seen in the past, which has been great, is down to Phil. So we're very excited to chat with him more about the company and understand what they're doing and why they may have screened so high in our stock screener. So welcome, Phil. Thanks for joining us.
Thanks for the invitation, Scott. Appreciate it.
All right, so let me start it off. For anyone listening who doesn't know your assets inside and out, could you tell us a bit about your producing assets just quickly and how you believe you were able to maintain one of the lowest decline rates in Canadian shale drilling?
Yeah, happy to. Our focus has always been on Western Canadian assets, primarily in Alberta, although we do have some assets in Saskatchewan as well. But the goal has always been to really focus on what we would call legacy assets. So these are assets that have been drilled for some time ago, and then we manage and operate them going forward. It's that's where we find the low decline. And for those of the listeners that are familiar with kind of the production decline photo of a well, you get a massive initial production, and then there's a harmonization of the well down to a longer payout over decades in many cases. And we tend to focus on the assets that we've been buying, tend to focus on that tail of the productions, which is why we have, as you've mentioned, we have the lowest production decline of any public company in Canada.
That's great. Yeah, that's powerful, right? Because it lets your reinvestment rate is lower. You have more certainty of what's going to happen next year, not as many surprises. So it gives you more flexibility in how you manage the company, right?
That's exactly it. I mean, when I started, as you mentioned, I started in 2012. So I was employee number one, but my chairman of the board was a gentleman by the name of George Fink. And in my view, George ran, I think, one of the most sustainable dividend oil and gas names for decades, which was Bonterra, paid out over $1 billion of dividends. I mean, George paid himself over $100 million of dividends during that period of time on a fairly small base. And that's interesting. I found your whole the research work that you guys did fascinating, and I'm a bit of a geek on this stuff. But the fact that it, as you guys pointed out, it didn't just highlight a bunch of microcaps that here's your leverage and there's got to be risk to we filtered very well with some companies that are multi-billion-dollar market cap. But it all goes to that sustainability of a dividend. And that's always what we've been trying to build for the last 12 years. We just started the dividend last June, but the goal was never changed for 12 years. It was to build a natural gas dividend company off Canadian assets.
Interesting. So maybe just expanding on that. So you've been with the company for 10 years. Can you kind of tell us what is your long-term strategy for Pinecliff, and has it changed versus what you think how the world works now versus what you've done the last 10 years?
You know what? It's gotten stronger. I always felt that natural gas was going to be a very important part of the energy profile for decades to come, and I believe that more now than ever. And a big reason, one thing that actually happened right during the time that we've been, founded Pinecliff and have been operating Pinecliff, is that North America, specifically the United States, has become the single largest LNG exporter in the world. In 2016, they exported zero. So only 7 years ago, they were at zero. Today, it's over 14.5 BCF a day, making them the world's largest export. That has a huge impact on all natural gas producers in North America. And what makes it even more exciting for Canada and for producers in Canada is that we're finally on the right side of the pipe for LNG starting on the West Coast in 24 months from now.
Yeah, I think it's been slow going in Canada to get those LNG facilities going, but I think you just need that first company to go and the government to see how successful this is and the opportunity, because the rest of the world needs so much of our cheap gas, and that will open the floodgates. And I know that from an economics perspective, there's lots of cheap resources in Canada. You guys have a huge opportunity to be a global leader like the US is becoming in LNG, in our opinion.
I agree with you. I think it's going to be the one thing, one of the few advantages Canada has over the United States when it comes to LNG. You'd think we're starting late. Yes, we can all be very remiss and look back and wish we had the 18 facilities that used to be on the books. I think the better way to look at it is we're actually getting one built. It's the single biggest project in all of Canada right now, $40 billion project, and it's got the ability to expand. It's got the pipeline capacity that's already being built, doesn't need to be expanded. It just needs to add compression. So you could easily get to 4 BCF a day very quickly just from that one facility. And just for your listeners' context, we only produce 18 BCF a day in Canada today. So to be able
Yeah.
to start exporting 4 BCF a day, that's a big number. We're talking over, getting close to 25% of all of our production. So it's super exciting, and the advantage we have over the U.S. is that because of political reasons, they really can't build LNG facilities on their west coast because they got to deal with California and Oregon and Washington. All of be very difficult to build facilities. So Canada actually, ironically, is going to be competing with Mexico for that Asian market, and then Mexico will be using our gas directly or indirectly through the U.S. To do that. So I agree with you. We're in a great position as to really utilize Canadian Western Canada natural gas.
Yeah, the way I understand is you have a geographic advantage because you can export from the West Coast. Your costs of LNG to Asia are slightly lower than the US because of that location.
It's almost 50% less shipping time.
There
So
you go.
it makes a huge difference versus the Gulf of Mexico and having to go through the Panama versus going directly west because to the Asian markets, not to the European markets, but the
Yep.
Asian markets make up 66% of all of the imports of LNG, and that's not going down anytime soon. China is a huge importer of LNG, but so is Korea, so is Japan, so is all you're now seeing mainly in Europe especially, but we're seeing the building out of LNG import infrastructure like we've never seen before. The fact that Germany built an LNG import facility within 200 days. And again, it was predicated on and needed because of the invasion of Ukraine and that they don't have the Russian pipeline gas to access anymore. But it just shows how quickly this whole market is developing right before our eyes. It's quite fascinating.
Yeah, it's an exciting time to be an energy investor, I think.
I agree with you.
So, wanted to refocus maybe a bit on the company, and I wanted to ask you. So, we've seen commodity prices come off a bit the last month as people refocus on economic growth and fears of whether it's slowing. Do we get a recession in 3 months, 6 months, 9 months? So, let's talk about buffers against falling commodity prices. So, in your view, what's your biggest buffer? Is it your large cash balance or is it your lack of debt? So, if you needed to, you could obviously borrow quite a bit. Like, if you could have one, which is more important to you?
Cash. I'd always take cash if that's my two choices. You're seeing it already play out with some other names that have gone dividends that are in your list that are going to keep their dividend because they've just in many cases just started their dividend,
Yeah.
but it's pretty obvious that they're probably going to have to use debt. Now they've got, the entire industry has got stronger balance sheets than they've ever had in the history that I've been around. And I've been around since the early 90s in the energy sector. So this is they can do that. I personally, my own view is that if we can, we have our commitment for 2023 is about $46 million is what our dividend commitment is. We have close to 60 million in the bank. So it is, and that's shareholder money. That's the way I look at it. It is I don't think I could have given those out in special dividends. I could have saved it for a buffer, which is what we chose to do. We've grown by acquisition. And so, we've gone from 100 barrels a day when I was employee number one to 21,000 today. We intend to still be acquiring assets, so that's a big reason why we kept the cash buffer. But another very solid reason of keeping that cash buffer is to make sure that our dividend's sustainable. We just started our dividend in June. The last thing I want to do is cut it. So I've got a really nice safety net for that dividend. I like the way the metrics that you guys use to look at that. Debt is, if you're going to run a sustainable dividend in a commodity business, you better run it with low debt because you cannot predict the commodity swings other than there's going to be swings. You just don't know when. You don't know. I mean, we're seeing there's so many. I mean, the Freehold LNG facility went down and it didn't come back as quickly as people thought it did. I mean, you couldn't predict that. We just had wildfires here in Alberta that drove up gas prices. We couldn't have predicted that they were going to happen in May. And to the extent that they did, I mean, things like that just happen. And so I think it's important to build flexibility into your model to be able to deal with these occurrences. Really, last summer, gas prices went to $10 because it was such a hot summer. And that compounded on the fact of the European, dealing with the Russian invasion of Ukraine. Again, all these things, all you can do is try to make your model as defensible as possible to deal with things that you're not going to be able to see coming at you.
Yeah. Now, what I'm curious about too is the debt, because you basically paid off all your debt at the same time you have this cash buffer. Was that like a macro view, or you just said we're making all this cash, let's de-risk, and then if we want to do M&A in the future, like what was the thinking to have the cash buffer and pay off all the debt?
Yeah, it was an abundance of riches, frankly. I mean, we had in 2021 we had the best cash flow year in the history of Pinecliff in our 10 years that we've been running. It was $59 million of cash flow. Last year we did $55 million of cash flow in one quarter. I mean, it was so we had an amazing amount. So we went, about $100 million swing last year from our debt position. Our net debt position swung $100 million to our cash position, and so it is. I did it just. Why am I paying interest if I don't need to pay interest? Was the very simple. It'd be no different than how you might handle your own personal bank account. It's like, well, it's kind of silly. So we paid it all off. We're very comfortable that if there is an acquisition that needs to have equity or debt, we're very fortunate with the shareholder base that we've built up. I mean, it was interesting because you guys talked about this, and I totally agree with you. So I'm at my heart, I'm an investor and always have been, and so I follow the markets. I find very, I'm like you. If I see a 10% dividend yield, it's a red flag. It's like something's going on. The stock price
Yeah.
must be
Anyone
dropping.
who's been in the market as long as we have you have been burned if you've gone chasing
Yeah.
after a 10%.
So you go, and I told my board this when we put the dividend in place, which I think we set it originally. It was like it's 6, 7, 8%, somewhere in that range. But I wanted people to get that red flag. I wanted to get on the filters. I wanted people to go, oh, there must be an issue with this P&E.
Very
Let's go
smart.
take a look at it. And then they go there and go, wow, these guys are debt free. They've got huge insider ownership. It's not unusual. It's fairly unusual that you got a $500 million company that, we got over 10% insider ownership. On top of that, one of the biggest institutional investors in all of Canada is our biggest shareholder, which is AIMCO. And so there's a bunch of unique characteristics. The low decline rate, we're single digit production decline rate. Anybody who's an oil and gas investor knows how rare that is. The industry average is like 28, 29% decline rate, and we've got it 7%.
Yeah.
So there's a bunch of things that I wanted to highlight when people come to us. I still think we're flying under the radar. The work that you guys are doing sure helps get us on people's radar. But we don't even have an annual dividend rate yet, right? I mean, until June kicks around, if anyone's plugging into Bloomberg, give me the best annual dividend rates, we're not going to show up yet because we haven't even had one full year of a dividend. But it's coming, and it's today we're over 10% dividend yield. I mean, you're heading paid to wait. I think is fantastic. I think that's you can try to
That's
time
how
when
we
that.
feel.
Yeah, I mean, the advice I give people when they ask me about it, I said, look, whatever you do, get some natural gas in your portfolio before 2025, because in 2025 the game changes. LNG out of North America doubles, and so that's really critical. It's gonna have a huge impact on supply and demand. Now you can try to thread the needle perfectly and buy at your absolute lows, or you can just buy some of these very strong stocks now and get paid to wait and not have to worry about trying to time this thing.
Yeah, that's a great way to look at it. I mean, that's the way we look at it. It's a unique time, I think, on the LNG front where you have a more visibility than usual in
Correct.
commodity markets. It's just you have this, is there going to be a recession or not? But that's more a short-term concern versus we're talking multi-years now. So this does make sense to buy a company that's going to be sustainable, and you get paid to go through that volatility, and then you're kind of off to the races because there is upside in these dividend payers like what we look at it with you guys is you do have upside to commodity prices. It's not just 10% is the best you're going to get. And a lot of these other companies seem to offer that too. So it's really a best of both worlds, is our opinion on it.
I agree with you. And there's some great names on your list. It wasn't very long ago, we were at over $2 a share. I mean, we're still, I think the hope around the energy sector is that at some point, a lot of the generalist investors just can't keep ignoring the return of capital that's happening in our sector.
Hmm.
And as they return, there's a high probability that we might see a bit of a share multiple increase back to where, I mean, we've typically over the decades traded 5 to 8 times. At times we've traded 10 times cash flow. I mean, we're trading now at 3, 4 times cash flow, right?
Yeah.
And it's so it's going to be a tide rises all boats. I think that if you're in this certain boats, I think you're probably going to get raised a little bit quicker or faster than some of the other names. And I think the metrics that you guys used are the same metrics that I look at as an investor. I mean, insider ownership's a big one for me. I really want to see that alignment of interest. I want the CEO to be lying at night, staring at the roof, worrying about his stock price, because it impacts his family and his personal wealth. And so that's a key one for me. I think having the nice thing about Pine Cliff is that it's a boring model from an oil and gas standpoint. There isn't a lot of execution risk where we can screw things up going into new fields. It's a manufacturing type exercise. It's us continuing to operate the same types of assets we've been operating for over a decade. I think there's going to be an opportunity for us to continue to consolidate that space, because we are the only public company that's focused on these assets in Canada. And again, they're not super exciting. Tourmaline, which is one of the companies that shows up in your list, is a fantastic company, very good company, very well run, but even though we're both 85% gas weighted, very different business models. In the last 3 years, they've drilled 840 wells. In the last 3 years, we've drilled 10. So just very different business models.
Yeah, that comes across in the financials, I think, and why you're on this screen so high up. Now, I wanted to ask you about the production profile because it's interesting. I noticed when you started, you had very rapid growth. I assume that was from acquisitions.
Correct.
And then then that tailed off and you decided to maintain your production for the last 5 or so years. Was that kind of integrating the acquisitions? And then you could see if pricing, say we have another commodity sell off because we get negative GDP growth for a quarter, could you see that growth coming from M&A again, or what kind of went on? Just take me through the history of Pine Cliff.
Yeah, we had this discussion just today, just internally with our management team. I was saying that there's going to be assets. There's always assets that are available, and we've been in the acquisition market now for 12 years. So we know we get the calls when an asset comes out. We look at that. I really am intrigued by this business model. I think we're 23rd biggest natural gas producer in Canada right now, but so I think the one comment I would have, or one criticism I get when I meet with big institutions, is that we're small. We're a $500 million market cap, which some listeners may think is large, depending on what they. But in the global, in the list of names that you've got on there, it is quite small. I think I'm quite intrigued by, can we build this model bigger and be more relevant to more people, more institutions, get in indices, etc., without giving up everything that the tenets that we built this business around. And I think that's possible. I think it is that we can continue to add assets. In 2019, 2020, we had the worst gas prices in 30 years in Western Canada, and we still made money. We didn't make much money, but that's where you saw that, where we quit drilling. It made no sense to drill. Why are you drilling? Why are you bringing on production when gas prices are $1.50? That makes no sense. A lot of the growth models, they don't have a choice. They've got a 30% decline rate, in some cases a 40% decline rate. If they stop drilling, it becomes a totally different, all their metrics fall off a cliff. Their G&A, everything's been built for that model. Ours is, we run this 21,000 BOE a day with 35 people in head office of employees and contractors. It's just a different model. So I think it's, will we see we saw some growth year over year in our production. The wells that came on were quite well. Matter of fact, we drilled one of the top Alberta wells in last year, one of our Pakiska wells. You find it on, I think, slide 32 in our presentation.
Mm-hmm.
Most oil and gas companies would have that in slide 2 or 3, but that's not what you're about. That's not what we're about. And I think I find that retail investors, family offices, we get very good traction with, because it's not a complex model. It's not a geology model. I don't have to explain Montney and Clearwater and yes, we are an oil and gas company, predominantly gas, but it's really a financial model. We're closer to a royalty stream model, frankly, than we are to the traditional E&P model.
That's a great way to put it, actually. I think that would help people listening to put it in perspective.
Yeah. I mean, what we have a lot of wells, and we're very proud of the fact that 90% of all of our wells are active. So that we've spent a lot of money on continuing to clean up, even in the really lean years. And before it was mandated, we were spending money on abandonment reclamation. We think that's just part of the business model. That's one of the costs. The one thing and you guys focused on this, and something I love when investors focus on, is free cash flow. And when I mean free cash flow, I mean after every single penny you spend. Like, I don't care how much you pay your officers, or how much what your G&A, or like, just tell me, after every single dollar you spend, how much money do you have left to give to shareholders? And I think that's where we really shine, is because we don't have to spend much on CapEx. We don't, most of the businesses, because they have the higher decline rate, they have to spend a lot more money than we do to keep their production flat. And so then I think a free cash flow, to me, is the best way to even judge oil and gas stocks against other industries. Like compare our free cash flow to anybody else's free cash flow. Then you start getting into the nuances, and your criteria and filters highlight that. Is it having low debt makes a huge difference, not just when in a rising interest environment like we're in right now, but just generally. I think it just allows, as an investor, you got a lot more security in a low debt, strong balance sheet scenario.
That's a great way to put it. Well, Phil, you've been very generous with your time. I don't want to take too much more, but if anyone else has any more questions before we head out, make sure to ask them now. Otherwise, this has been a great insight into Pine Cliff. Again, I would recommend checking out our note. There's a lot more information on the company. We looked at it, 10 different ways, and then you can go to their website and check out the company more, listen to conference calls, do that whole thing. That's kind of how you dig in. But hearing from the CEO who's been running the company for a long time, it doesn't really get much better than that. So Phil Hodge, CEO of Pine Cliff Energy, thanks so much for joining us today.
I thank you very much for having me. I would echo your last sentiment about, if on our website, we try to put I try to do a lot more of these types of things. So I've done some podcasts and some Twitter interviews. They're all on our website. We've got a sign up sheet. Every quarter, I put my macro thoughts together and send them out to people. You can sign up. It's all free. And I try to focus not so much on Pine Cliff, but on what's going on in the natural gas space. So I welcome any of your listeners to join our subscription list.
Great. All right. Well, Phil, you have a great day, and hopefully we'll talk to you soon. We'll be in touch.
Thank you very much. Appreciate it.
All right. Take care. All right, everybody. That was Phil Hodge, CEO of Pine Cliff Energy. That was a great conversation. Hope you enjoyed that. And I think we're going to wrap it up here for now. As always, thank you for being a subscriber. You're making all this possible. We got a lot more exciting analysis to come that we think is going to really help your process, help you save time, identify good ideas. We're going to be looking in different sectors, not just oil and gas. So definitely stay tuned. There's going to be a lot of exciting things from the Substack this year. And if you have any questions, you can find us, just email us, reply to anything you get from Substack. We're all here. So thank you again for your support. And I think we'll sign off here, and we'll talk to you again soon.